Hello and welcome to Session 9 of the Basic Tax course. We're going to begin Session 9 with a review of the Session 7 quiz answer key. And the first question we're going to review is question number 7. And this one has stumped students for years. Let's take a look at why. Qualified student loan interest includes interest on loans that paid for room and board, books, tuition and fees, or is it just books and tuition and fees? Those are your choices, or is it all of the above? And this question stumps students because students focus on the deductibility of expenses in terms of the tuition and fees deduction or in terms of the education credits, and not at the qualifying expenditures for which a student loan can be used. Now, clearly, if you're going to college, there are costs associated with books, supplies, and tuition, but there's also the cost of living that you have as a student. And the question is the cost of room and board that you pay when you are a student a deductible expense? No. But is it an expense that can be paid for with a student loan? And when you pay for it with a student loan and then later pay interest on that student loan, is the interest deductible? And in that case, the answer is yes. For more information, you should refer to Publication 17, page 138, Qualified Education Expenses. And I've actually opened the publication up to that page for you. Let's zoom in on the information, which is right here. For purposes of the student loan interest deduction, these expenses are the total cost of attending an eligible educational institution, including graduate school. They include the costs paid for the following items: tuition and fees, room and board, books, supplies, and equipment, and other necessary expenses such as transportation. And it provides some more information about the type of expense that qualifies for room and board. But essentially, the answer is E, all of the above. And the next question in line is question number 8. A taxpayer can contribute money to his or her spouse's IRA whether or not they file a joint return. The answer to this question is false, and to find out more, go to Publication 17, page 124, Spousal IRA Limit. And I have Pub 17 here open in front of you where it says Spousal IRA Limit. Now, the thing with IRS in its publications is you're not going to go into the IRS publication, at least in this case, and read a line that says, you may not do this, or you may only do this in this situation. Pub 17 tends to be worded more like, if you have this, you can do this. And in the case of the spousal IRA limit, that's the type of description we're looking at. It says for 2011, if you file a joint return and your taxable compensation is less than that of your spouse, the most that can be contributed for the year to your IRA is the smaller of the following amounts: $5,000 or $6,000 if you are age 50 or older, and the total compensation includable in gross income of both you and your spouse for the year reduced by the following amounts. So it goes on to show how much you are allowed to contribute to your IRA and your spousal IRA combined. But it doesn't go in there anywhere and say you must file a joint return. It just says that if you file a joint return, these are your limits. And it doesn't go into filing separately at all. So it can be difficult to extrapolate sometimes the facts and the meanings from those situations, but you do need to file a joint return in order to contribute to your spouse's IRA, is the bottom line. The next question in line is question number 16. The due date for contributing to a SEP or simple IRA plan is C, the due date of the return, including extensions. Now, why is this the most frequently missed question? Well, most tax preparers focus on the April 15th filing deadline, and April 15th, except in the case when it falls on a weekend, is the filing deadline for the 1040 return, and it is also the final date that you can contribute to your own or your spouse's traditional IRA and claim a deduction. But a simple or SEP IRA have different rules, and for SEP and simple IRAs, the due date of the return, including extensions, is the final date at which you can make contributions to these plans. So 16C is the correct answer. Number 17, you can claim a deduction for alimony paid on either Form 1040A or Form 1040. That's just a flat-out false. If you are claiming a deduction for alimony paid, you need to file the long Form 1040. The next question we're going to review is question number 19. Per your divorce decree, you must pay the entire mortgage payment on a home you jointly own with your ex-spouse. Your payments are A, partially deductible to you as alimony, or B, fully deductible as alimony, or C, not deductible to you as alimony? Well, if you go to Pub 17 and read up the instructions on what to do in the case of paying full mortgage payment on a house that's jointly owned by you and your ex-spouse, you will see that the answer is A, partially deductible to you as alimony. So here I am on page 135 of Publication 17. I'm looking at the paragraph mortgage payments. If you must pay all of the mortgage payments, principal and interest, on a jointly owned home, and they otherwise qualify as alimony, you can deduct 1/2 of the total payments as alimony. If you itemize your deductions and the home is a qualified home, you can claim 1/2 of the interest in figuring your deductible interest. Your spouse must report 1/2 of the payments as alimony received, and if your spouse itemizes deductions and the home is a qualified home, he or she can claim 1/2 of the interest on the mortgage in figuring deductible interest on the spouse's Schedule A. Moving on to the next question. Question number 21. The 2011 health insurance deduction for the self-employed is what percentage of the total insurance premiums paid? And the answer is 100%. I don't know why students still have a problem with this. It's been 100% for at least the last 10 years. Many, many years ago when I first got into the industry, the self-employed health insurance deduction was limited to a percentage of the premiums paid for health insurance. But that phased into the 100% range many, many years ago. If you are allowed to claim a deduction for health insurance premiums paid as a self-employed health insurance deduction, the amount is 100% of the premiums paid, with the exception of if you didn't have enough self-employment earnings, you have to have, there are some limits there. But in terms of the deduction itself, how is it figured? It is 100% of the premiums paid. And now we're on to the mini problem. Lex Luthor moved to a new job on August 1st, 2011, and his employer reimbursed $500 of his allowable expenses, which included the following: moving of household goods, $1,500, shipping his pet cat, $250, storage of furniture for 5 months at $100 per month was $500, lodging while driving to his new home was $200, and meals while driving to the new home was $100. So the first thing I do when I look at a problem like this is determine which of the expenses are going to be allowed and how much will be allowed. The first one is the moving of the household goods. Is that allowable? Yes, it is. The moving of his pet cat. Is that allowable? Yes, it is. The storage of furniture for 5 months at $100 per month. Well, it's partially deductible. We get 1 month, so that would be $100. The lodging while driving to the new home of $200, is that deductible? And the answer is yes. And then meals while driving to the new home, is that deductible? The answer is no, it's not. Lex drove his car from his old home to his new home, a distance of 1,000 miles. His old commute to work was 10 miles. The distance from his old home to his new job is 1,000 miles. Well, we need to be able to show that his commute from his old home to his new job is more than 50 miles farther than from his old home to his old job. So we see that we passed that test. The next thing we look at is how many miles did he move? It was 1,000 miles. And he would be able to claim a deduction of 23.5 cents per mile, and that gives us $235. So let's take a look at his finished 3903 form. And here we have on the screen in front of you now Lex Luthor's Form 3903. We begin on line 1 by entering the total amount of expense paid for transportation and storage of household goods. We had the cost of packing and shipping at $1,500, the cost of moving his pet cat at $250, and the cost of 1 month of storage at $100. So when we add all of that up, we get $1,850. That's the amount we enter on line 1. Then on line 2, it says travel, including lodging from your old home to your new home. Do not include the cost of meals. Well, the cost of lodging was $200. The mileage was $235. We add those numbers together, and we get $435. We add those two numbers together, that is $1,850 and $435, and we get $2,285. Next, we have to subtract out the employer reimbursement that was $500, and on line 5, we enter his total allowable deduction of $1,785. So that concludes the review of the Session 7 quiz answer key. Let's take a look at the Session 8 homework assignment now. And I have up in front of you now the homework assignment from Session 8. It involves preparation of a tax return for Leonard Baker. So let's just break this problem down into its component parts, and then we'll move over and take a look at the finished return. Leonard Baker is married to Sue Baker. We give you dates of birth, but clearly place them at under the age of 65. They have a son who lived with them all year, but if you figure out his birth date, he is over age 17. He's actually 27 years old. And at the age of 27, if he works and has $8,300 of income, they're not going to be able to claim Mark as a dependent. So he is not a dependent. However, when we look at medical expenses paid for a person who could have been your dependent except they fail the gross income test, Mark's expenses are going to be qualifying expenses for them. Then we have Sue's dependent mother who is in a nursing home. They paid all of the cost associated with that nursing home care, and that was $1,900 per month. Her Social Security income is not paying more than half of her support. They're able to claim her as a dependent. And we have $1,900 per month of medical expense that they paid for Sue's dependent mother. At times 12 months, that's $22,800. During the year, the Bakers had additional income and expenses as follows. We see there's some interest income, there's U.S. bond interest, there's ordinary interest, and there's this tax-exempt interest from the City of Fresno. And here we are on the next page of the Session 8 manual looking at the expenses for the Bakers. I've highlighted the ones that are deductible, and let's talk about them a little. Firstly, we have medical insurance premiums paid for Mark and the medical bill that was paid for Mark. Mark passes all of the dependency tests except one, which is the gross income test, and if that's the only test he fails, then it means that the Bakers do get to claim his medical expenses. So we're going to say yes to the $1,950 and yes to the $3,000. Then we have the pre-tax medical insurance. And clearly, if you have pre-tax medical insurance that has been subtracted from your income, you're not going to get to deduct it a second time. So we don't claim a deduction for that. Then we have the after-tax supplemental medical insurance. Is that a deductible amount? Yes, it is, because it was paid with after-tax dollars. Then we have something called long-term care premiums paid for Leonard and long-term care premiums paid for Sue. And we'll see that we have an amount of $1,375 and another amount of $1,037. Let me draw you over to the answer key for this problem, and I want to point out that the long-term care insurance premiums paid for Leonard are $640 and long-term care for Sue are $640. We've got a little asterisk there, and it says even though Leonard and Sue paid long-term care insurance premiums of $1,375 and $1,037 respectively, they are limited to $640 for each in the amount that they are allowed to deduct. So yes, the long-term care insurance premiums are deductible, but you have to be careful about your client's age. If your client is too young, they're going to be subject to a limit on the amount of deduction they can claim for the premiums paid on long-term care contracts. Then we move over to property taxes paid in November for the period of time 7/1/11 through 6/30/12. Those are deductible, and so I've highlighted those as a yes. And then the personal property tax on the car is deductible, as well as the personal property tax paid on the motorhome. So when we look through and add up all of the medical expenses that we have for the Bakers, we end up with a deductible medical expense of $30,230. Let's take a look at the rest of their tax return. There's one more item we see down here, and it says $2,300, and that is the amount of income tax that the Bakers paid for the year. It was withheld from Leonard Baker's income on his W-2. It is a deductible expense for him. And so that deductible expense of $2,300 is also going to go on his Schedule A. So essentially the Bakers are claiming Schedule A deductions for two categories of expense. One of them is medical, one of them is tax, and the deductible taxes are highlighted in pink, and the deductible medical expenses have been highlighted in green inside this manual. So let's go over and take a look at their finished return now. And I have up for you now Leonard Baker and Sue Baker's tax return. You will see that they are married filing a joint return. We've checked 2 for married filing joint, and we've given them 2 exemptions for themselves. The only dependent listed is Stephanie Martin, who is a parent. We've claimed a deduction for her. Total exemptions will be 3. We then have Leonard Baker's W-2 in the amount of $56,575, and we had Box 1 and Box 3 interest combined in the amount of $1,600. Since $1,600 is more than $1,500, we will need to complete and attach Schedule B. On line 8B, we enter the City of Fresno interest. That's a tax-exempt interest. On line 9A, we enter the non-qualified dividends that were received. And on line 10, we enter the taxable refund that the Bakers received. Their total adjusted gross income is $58,775. And moving over to page 2 of the return, we have itemized deductions of $34,176. So let's see the Schedule A so we can see how that was computed. On line 1 of Schedule A, we enter the total medical expenses. And I've already showed you where that number came from, but let's take a look at it again. Right here you will see we have $3,000 in medical expense paid for Mark. We have after-tax supplemental medical insurance. We have the medical premiums paid for Mark. We have the long-term care contract premiums paid for Leonard and Sue after applying the limit, and the nursing home costs for Stephanie. That's $30,230. The next number we need to make note of is the adjusted gross income. That $58,775 is going to be entered on line 2. So line 1 is the total medical expense. Line 2 is the adjusted gross income. We multiply the adjusted gross income by 7.5%, and we enter $4,408 on line 3. We then on line 4 enter the difference. So the amount of deductible expenses for the Bakers is their total medical minus 7.5% of their AGI. Then we enter the amount of taxes paid, and the first tax we enter is income taxes that were shown on Leonard's W-2 as withholding for his state, and that was $2,300. We then have real estate taxes that they paid on the home and personal property taxes they paid on their motor home and on their car. So the total taxes that they paid are $8,354. And that gives them total itemized deductions of $34,176. We take that back to the Schedule A and enter it on line 40. We then enter the exemption deduction in the amount of $11,100, and we get taxable income of $13,499. The tax on that is $1,348. Since they had $4,000 of federal withholding showing on Leonard's W-2, there is a refund of $2,652 that is coming to them. In the answer key, we also have a copy of their Schedule B showing the amount of interest income that they had and the amount of dividend income that they had. And then finally, you will see that we've included something called an overflow statement. And we actually generate these overflow statements inside our tax software. Whenever I do a tax return in tax software and I'm making multiple entries in there, I really want to know for my own reference and my client's reference where a particular number came from. So I use these overflow screens inside my software to describe entries that I'm making, and then we provide our clients with a copy of those overflow screens. So you will see in answer keys that we provide that there's frequently going to be an overflow statement, and we'll use that to describe where we get our numbers from. We may describe it in other parts of the answer key as well, but we figure the more places we give it to you, the better, and the clearer it is. For example, it says Schedule A, Line 8, personal property taxes. We have the car at $379, the motorhome at $1,675. The total is $2,054. And if we go back up to the Schedule A, line 7 is $2,054. So it's just explaining where that number came from. But the overflow statement is not a part of the return. It's not a form you are required to complete, and it is not a form that is ever filed with the IRS. So that concludes the review of the Session 8 homework assignment. It is now time to complete the Session 8 quiz. Please push pause on video playback and complete the Session 8 quiz. When you are finished, please resume video playback to attend the Session 9 lecture. We are going to, of course, be covering itemized deductions, and in specific, we're looking at Schedule A at the items contained in this red box: interest that you paid and gifts to charity. So throughout today's class, I will be referring to line numbers on Schedule A, and occasionally I will also be referring to line numbers on the 1040 form. If you have those forms handy, it will help you follow along with me better. You may not have line numbers memorized, and I will be referring to a line, and it may mean something to you or not, so if you have the manual handy, that's best. So we're going to start really at the beginning with some very simple stuff that most of you probably already know, but we like to cover all the bases. And the first one is, of course, that you use Schedule A to figure your itemized deductions, and in most cases, your federal income tax will be less if you take the larger of your itemized deduction or your standard deduction. And if you itemize, you can deduct a part of your medical and dental expenses, unreimbursed employee business expenses, and amounts that you paid for certain taxes, interest, contributions, and miscellaneous deductions. In some cases, you can also deduct certain casualty losses. So let's take a little bit of a look at some of the real basic stuff. Who must itemize deductions? Because there are some people who are required to. It's not even optional.
The first one is if you are married filing separately and your spouse itemizes deductions on his or her return, well, then you're required to itemize your deductions. Whether or not the standard deduction is higher, you would be forced to itemize. The next one is if you are a non-resident alien filing Form 1040-NR. 1040-NR actually has itemized deductions built into it. It does not allow for or provide for a standard deduction. However, there is a tax treaty between the United States and India, and certain residents of India get a standard deduction on 1040-NR, but only residents of India. So who should itemize deductions? Because if you're not forced to, is it a good idea? Well, the answer is you should itemize your deductions if your total itemized deductions are more than your standard deduction, or even if your standard deduction is a higher number, in some cases you can still be better off itemizing if you are paying the alternative minimum tax. Under the alternative minimum tax, you are not allowed to claim a standard deduction. It is taken away from you. And so for that reason, you can be better off itemizing even if you only have a small amount of deductions to itemize. So what exactly are itemized deductions? Well, itemized deductions are deductions that you claim instead of the standard deduction. And of course, you can itemize your deductions on Schedule A, or you can claim the standard deduction, but never both. Now, if you do itemize, you have to file long form. You can't file short form 1040E or easy or Form 1040A. You're going to have to file the long form. And of course, an important rule to remember about all itemized deductions is you are never allowed to double deduct, and that is really true for the tax code everywhere, but a lot of people have a hard time grasping that, so I put it in big bold letters. Also, you have to use after-tax dollars to pay an expense that you wish to claim as an itemized deduction. In addition, you may not claim a tax benefit for the same expense in more than one way. If you claim an itemized deduction for an item that is also eligible for another tax benefit, you may not claim a double benefit. And here are some examples of where a tax benefit is available in more than one way that could impact whether or not you should claim that deduction on the Schedule A. Firstly, employer-paid or pre-tax health care plan at work. If you're already participating in a pre-tax health care plan at work, clearly you've got the deduction built in on your W-2 already, and you cannot claim the cost of your pre-tax health insurance as an itemized deduction. Also, flex spending accounts. Flex spending accounts allow an employee to put money, pre-tax money, into an account, and they can then spend money from that account on qualified expenses such as medical, and that also is pre-tax. So if you pay medical expenses with money inside a flex spend account, clearly you cannot take a deduction for those expenses. Also, if you have a health savings account or an Archer MSA and you pay for medical expenses with funds that are distributed from these accounts, you cannot then claim an itemized deduction for those same medical expenses.
And the Session 9 password number 1 is outlaw, O-U-T-L-A-W.
Okay, interest expense is the next topic of the day. In general, you may deduct only 2 kinds of interest on Schedule A. Other types of business-related interest are not a part of today's discussion. You can claim a deduction for interest you pay on your first or second home mortgage. You can claim a deduction for investment interest to the extent that it does not exceed your investment income. And that's it. That's the kind of interest you're allowed to deduct. Now, back in the olden days, we're talking before I even got into the industry, and I've been in it since 1992, late 92. 93 was the first year, I believe, that all of the phase-out finished for tax law changes that came in under Reagan. So when Reagan came into office, he did a major restructuring of our tax code. And prior to that restructure, personal interest was deductible. If you paid interest on a car loan, it was deductible. If you paid interest on credit cards, it was deductible. And that was taken away, and it phased out over a period of time. And I think 1991, possibly 1992 was the very last year that deduction was ever allowed. And ever since then, there's only been 2 kinds of deductions for interest you're allowed on Schedule A. One of them is home mortgage interest, and the other is investment interest. So we're going to talk about those two today. And of course, interest deduction is claimed on lines 10 through 15 of your Schedule A. And you'll see line 10, it says home mortgage interest and points reported to you on a Form 1098. Now, if you have a client who has a 1098, and the 1098 is representative of the full deduction they have for the year, you enter the deduction on line 10. But it's possible they have more mortgage interest to deduct than appears on Forms 1098. And if they have deductible mortgage interest that does not appear on a 1098, please do not put it on line 10. Because line 10 is a number, or is a line that the IRS matches up with 1098s. And if your client has a larger number on line 10 than is showing on the 1098s issued for the year, your client's basically going to get an audit. Maybe not a call downtown to bring in your receipts and come downtown audit, but they're probably going to get a paper audit. They're going to get a CP2000 letter from the IRS saying, hey, the deduction you claimed on your tax return is larger than we think it should be. Explain this to us. And if you can't explain it, pay this extra tax. So clients don't like getting those kinds of letters. As a tax preparer, you might calculate the correct deduction, but if you put the deduction on the wrong line, it will cause a problem for your client. So please pay attention. Line 10 says home mortgage interest and points reported on Form 1098. Line 11 says home mortgage interest not reported to you on Form 1098. And if it was paid to a person from whom you bought the home, you should see instructions and then show that person's name, identifying number, and address. Well, the reality is anytime I've ever entered a number on line 11, my software screams at me that I have to put a name, address, and identification number on here. And very often I'm using this for a bank. For example, if a person has purchased a travel trailer, that travel trailer would qualify in most cases as a second home, and the interest on the loan that secures that travel trailer is going to be deductible. But banks that do loans on travel trailers don't send out 1098s. So in that situation, I would be entering the name, address, and identification number of the bank to which that money was paid. Line 12 says points not reported to you on Form 1098. Now, at the time a person purchases a home, if points were paid, typically they show up on the 1098 in the points paid box. But very often I have observed that the points in the points paid box are wrong. Either the box is completely blank, or it has too low a number, and sometimes it has too high a number. Now, how would I know as a tax preparer that the number was too high, or too low, or missing? Well, I would get that information from the closing document. So I ask my clients when they purchase or sell a home to bring me their closing papers. I'm looking at the closing papers for two key things. One is the proration on real estate taxes, because there nearly always is a proration that needs to happen. And the second is I'm looking for points. Are there any points on these closing papers? And rarely, but sometimes, the points on the closing papers are a perfect match to the 1098. And if the points on the closing paper are a match to the 1098, then the points go on line 10. But most of the time, the points on the closing papers differ from the points on the 1098, and any additional amount not reported on the 1098 would go on line 12. And then we have on line 14 investment interest. Actually, pardon me, line 13 is mortgage insurance premiums. Those are entered on line 13 if you have deductible mortgage insurance premiums. And then on line 14 it says investment interest attached Form 4952 if required, see instructions. So we're going to be covering that form today. So mortgage interest, what is it? Well, interest you pay on a loan that is secured by your main home or your second home is home mortgage interest. You must meet these tests to claim a deduction for the mortgage interest you pay. You must be legally liable for the loan, and there must be a true debtor-creditor relationship between you and the lender. The mortgage must be a secured loan with your home offered as collateral. And what portion of your interest is deductible? Well, there are some rules for that. They've been around a long time now. Firstly, there's something called grandfathered debt, mortgages that were taken out on or before October 13, 1987. Can't imagine there's too many of those out there anymore. Then there's home acquisition debt, mortgages you took out after October 13, 1987 to buy, build, or improve your main home, plus any grandfathered debt that totals $1 million or less. And that's the key point. It's $1 million or less. There is a cap on the amount of interest you can deduct for your home mortgage interest payments, and that cap is set at the interest payable on the first $1 million of indebtedness. Now, for most homers, $1 million is never going to happen. It would be a far-off dream that I would ever own a house that cost more than $1 million. But it is not hard to get to $1 million home in a high-cost area. If you're in San Francisco, if you're in New York, for example, you're going to be in high-cost areas where it would be hard to buy a 900 square feet for under $1 million. So it's easily conceivable that you're going to have clients in some high-cost areas that could be approaching $1 million. And even if it's not a high-cost area, the cost of housing just in general has been climbing over time. And $1 million house back in 1987 was a heck of a lot different than $1 million house today. So this is a limit that may start to have more impact on people as we progress with inflation over time, because this $1 million limit has never once been adjusted for inflation. There's also something called home equity debt. Mortgages that you took out after October 13, 1987 that are other to buy, build, or improve your home, but only to the extent that the total of all of these loans was $100,000 or less and totaled no more than the fair market value of your home reduced by 1 or 2. Well, is it possible that we have home equity debt out there right now on a house that makes the debt on that house greater than the fair market value of the house? There's probably a lot of that. We were in a cycle all through the 90s and the early 2000s of banks lending willy-nilly on houses, and actually situations where people were upside down equity-wise in their house, that they owed more on the house than it was worth, sometimes through refinances, sometimes through home equity loans. And so that's something to watch out for. If your client comes in and they have a mortgage for $400,000 and they have a home equity line for $50,000, that house has to be worth at least $450,000 for all of that interest to be deductible. And if they have a mortgage for $400,000 and they have a home equity line on the home for $200,000, and the home equity line was not used for home acquisition or home improvement, then you're going to be limited to the first $100,000 of debt and the interest paid on that $100,000 of debt on that equity line. So there are a couple of mental calculations to be doing there when you're looking at stuff. Most of the time it's not a problem, but the potential for it to come up is certainly there. Now there are some special situations where you might be looking at deductible home mortgage interest and not even know it. And one of those is late payments or charges on mortgage payments. So when you make late payment on your property tax bill, you're going to be assessed interest, but that's not deductible interest. When you're looking at a late payment on your mortgage to the mortgage company, they're going to assess you interest, and that interest is deductible. So you would add a late payment charge to your mortgage interest for the year, and typically they would put that on the 1098. Mortgage prepayment penalty. You might have purchased a home on a 5-year ARM with a 3-year clause that says if you pay off this loan within the first 3 years, you're going to have to pay a prepayment penalty or prepaid interest. And so that type of thing is going to be deductible. Prepaid interest, however, you must spread this interest as a prorated amount over the life of the loan. Prepaid interest is typically points, and points may be deductible. If they're not deductible currently, typically you would deduct them over the life of the loan. Ministers and military housing allowance. Even if you are exempt from tax on your housing allowance, you can still claim mortgage interest you paid as an itemized deduction. Divorced or separated individuals. If your divorce agreement requires you to pay the mortgage on a home owned jointly by you and your spouse, but you do not live in the home, 1/2 of the mortgage payment may be considered alimony, and you deduct the other half of the mortgage interest paid as an itemized deduction on your return. Points. Points are never called points on the settlement statement. Points are a word that is used in the tax world. It's not a, and points are sometimes, you hear the word point all over the place, and our clients hear points all over the place, and 99% of the time that my clients paid points, they think they didn't. Because the settlement statement does not call them points. The settlement statement calls it a loan origination fee or a loan discount fee. I've never read a settlement statement that said points. And I think that probably the mortgage lenders themselves try and avoid the term. They'll call it, well, there's going to be a loan discount fee here, because that sounds pretty good, you know. We're discounting your loan, but there's a fee for it. Well, that's what a point is. So if I ask my client, did you pay any points, I'm typically going to get no, even when they did. If I say, did you pay the loan origination fee, they're probably going to say no, even though they did. So essentially, I just ask for the closing papers to look for the number, because what they tell me doesn't mean anything. And even if they know that they paid it, they probably don't know the number, so I still want to see the closing papers. All right. So points are a form of prepaid interest, and generally you must itemize points you paid over the life of the mortgage loan. You can fully deduct points in the year paid if you meet all of the following tests. Number 1, your loan is secured by your main home. You must amortize points you pay on your second home. Paying points is customary in the area in which you live. The points charged were not more than points generally charged in your area. You use the cash method of accounting. Points paid were not a substitute for other common closing costs such as escrow fees, down payment, title fees, etc. The funds you provided at closing were at least as much as the points charged. You use your home to buy or build your main, or you use the loan to buy or build your own home, your main home, or to improve your main home. The points were computed as a percentage of the principal amount of the mortgage loan. And finally, the amount is clearly shown on your closing or settlement papers. If you meet all of these tests, you can choose to deduct the points paid in the year you pay them, or you can amortize them over the life of your loan. But if you refinance, generally you must amortize points you pay to refinance, even if the new mortgage is secured by your main home. If you amortize your points, you can claim a deduction for points as a prorated amount each year. And if you pay your mortgage off early, you should claim a deduction for all of the remaining unclaimed points in the year you pay off the loan. Well, tracking clients' points year to year takes some brain power, because if you refinance a loan, there's points that show on the settlement statement, and you might ask your client for that settlement statement in the year of the refinance, and then the next year they come in and do their return, and there's no 1098, there's no refinance, but there's still this amortizable amount being carried forward. So what I do is I have a data entry screen in my computer where I go in to where points are deducted, and I enter in a blow up there how much point was paid in what year and allow it to carry forward. And so every year I'll go in there, I'll see that field highlighted, and I'll figure the amount and enter it. Another methodology is to use amortization schedules built into your software and carry them to Schedule A. If your software allows you to do that, that's another way to do it. But either way, it's something that takes a manual action, and you're not going to remember a year later that your client paid points, and you're not going to remember when they sell how much has not been claimed unless you're putting some triggers in there for yourself. Now let's take a look at who might possibly pay points. There can be a situation where points are paid by the seller, and if you buy your main home and the seller pays the points for you, you should deduct the points as if you paid them yourself. But your cost basis in the property is reduced by the amount of points that the seller paid for you. Now, if you are the seller and you pay points for the buyer, you may not claim the points you paid as a deduction. The points you pay increase your basis in the property and reduce your net profit from the sale. And here is sample closing papers, and I'm going to show those to you. We have points that were paid in the amount of $1,519, and they are deductible on the return. So we see here that we have all kinds of lines with all kinds of numbers, but in the end, the one I care about is this one right here. Your loan origination charge. Here it actually uses the word points. That's interesting. Your credit charge points for a specific interest rate chosen. But we're looking at the loan origination charge. It's 1%, $1,519. It is a percentage of the loan amount. The loan amount was $159,000. So they are actually getting this as a percentage of the loan. And this is the number that is deductible. But you'll see there's also an appraisal fee, there's a credit report, there's tax service fees. Down here on line 901, it shows daily interest rates charged from the date of close till a few days later at a rate of $24 a day. That's also not points. That is an amount that should show up on the 1098 when it's issued, so I wouldn't be grabbing items that are required to be paid in advance down here and treating them as points, because that's not what they are. And it is the lender's responsibility to track interest paid for the year and report that on a 1098. So if the lender has done their job correctly, that should be on the 1098. This amount up here, the $1,519, could be on the 1098. Wouldn't it be wonderful if it was? And if the $1,519 is on the 1098, then we would report it on Schedule A on line 10. And if it's not on the 1098, we'll report it on Schedule A, line 12. Here is the 1098 mortgage statement. Most banks issue a 1098 that looks something like this. Box 1 is where the mortgage interest is noted on the form, and whatever amount is in Box 1, you would carry to line 10 of Schedule A. Box 2 is where points were paid on the purchase of a principal residence, and if it happens to be that the points paid in this box are an exact amount to what is on the closing statement, you would include the amount in Box 2 on line 10 of Schedule A. But if Box 2 is more than the amount that's shown on the settlement statement, I would only enter the amount shown on the settlement statement because that would be an error. And very often what I see is a settlement statement that has a number that is higher than this. I also see situations where a person will buy their house through a broker and pay points to that broker, and that a broker immediately turns around and sells that mortgage to another mortgage company. And a 1098 might come out from the broker showing a half month of mortgage interest paid and no points showing on it at all. And then the other mortgage company that now assumes that loan shows no points either and more mortgage interest. And so the points are just lost unless you know to go looking for them in the closing papers. Refund of overpaid interest is showing in Box 3. Mortgage insurance premiums are showing in Box 4. And then in Box 5, sometimes I see seller's share of real estate taxes typed in a number. But Box 5 is essentially a box that is optional for the issuing company to fill in. And sometimes they have a number in there and sometimes they don't. You just have to read it and see what it says. Now what happens if you have a seller financed mortgage that is not reported on a 1098? Well, I already showed you what you do. If you have a seller who finances a mortgage and there is no 1098, you need to complete Schedule A line 11 and enter the name, Social Security or EIN number, and address of the group or company that you are paying. Here's an example. We have Wilma Deering, who has received mortgage interest in the amount of $6,500. This is her Social Security number. This is her address. We can also see that it looks like this particular person who has a Schedule A has another loan on their home, maybe a home equity loan, but they've paid $500 of mortgage interest that is on a 1098. They've paid $6,500 that's not on a 1098. And it looks like they are paying some mortgage insurance as well. And then we have investment interest even. Oh, pardon me, mortgage insurance. Oh, points, that's it. It's hard to read this. So line 12 is showing points, not on a 1098. And line 13 is showing the mortgage insurance premiums that were paid. Speaking of mortgage insurance premiums, let's learn about the rules for those. You may be able to treat mortgage insurance premiums you paid in 2011 as home mortgage interest. So it's not that, what's the way to put it? The IRS is still saying that there's only two types of interest you can deduct, mortgage interest and investment interest. And they're not saying that you can claim a deduction for insurance. What they're saying is that certain kinds of mortgage insurance are going to be considered interest. And in a way they are. If you purchase a home and you pay less than 20% down, most mortgage companies are going to demand that you carry a mortgage insurance policy on that home. And the mortgage insurance policy is usually some ridiculously high amount that adds to your monthly payment. If you have a $1,200 mortgage payment and you put the $3,000 or 3% normal amount down on an FHA loan, they're going to tack another $150 or $200 a month on for mortgage insurance. It's an outrageous amount of money, and historically it was never deductible. And then sometime around 2004, 2003, somewhere in there, they passed a law to make mortgage insurance premiums deductible. But in order to be able to deduct them, you have to have income that is low enough. And actually the magic date was 2006. Yeah, so you have to have a mortgage insurance contract that was issued after December 2006. So mortgage insurance policies that were in place before then, they're not deductible. It's only ones that have come into being after then. And if you are allowed to deduct it, you have to look to income first. The income has to be less than $100,000 on a joint return or $50,000 if separate to claim a full deduction. If your income is above that amount, you might be allowed a partial deduction, but the phase out is pretty rapid. By the time your income hits $109,000, you are not allowed a deduction at all for married filing joint and or any other filing status. And if you're filing separately, it's half that amount. There is a worksheet to figure your deduction. And essentially it says how much did you pay in qualified mortgage insurance premiums, what is your income, figure or phase out. If your income's too high, you don't get a deduction. If your income's low enough, you get a deduction. Put it on the form. Next, we have qualified investment interest. Investment interest is something that a number of people pay for, but you may not even be aware that they're doing it. And the way you figure out if they are doing it is by looking at their brokerage account statements. If they have 1099 dividend statements, say from Morgan Stanley or Smith Barney, for example, they're going to possibly have some investment interest on them, and they usually call it margin interest. And essentially, margin interest is you have a margin account, you borrow against that account to purchase investments, and then you might pay that account off again later when you sell that investment. And the margin interest is a form of investment interest. There's a question in the classroom, would it show up on a K-1? Well, it's possible that if the K-1 is investing and borrowing money to make those investments, that the K-1 could possibly show investment interest. That can happen, sure. I don't see it very often, but it's possible. Qualified investment interest is interest you pay on money borrowed for investment purposes. If you borrow money to purchase stock or other investment property, you have investment interest. Investment interest is deductible to the extent that you have investment income. So that's the question. Do I have investment income? How do I define investment income? And the IRS says that investment income comes from interest, dividends, annuities, and royalties. Other kinds of income that we might think of as investment income are not investment income, and key among those is capital gain income. Capital gains are, well, capital gains. Investment income is interest and dividends and royalties and rent. So if you have investment interest, you're allowed to claim a deduction for it if you had investment income. Now, even though you might not have investment income, or maybe you don't have enough investment income, you could make an election to treat capital gain income as investment income. But IRS says if you choose to treat your capital gain income as investment income, then your gain has to be taxed at ordinary rate rather than capital gain rate. You can't have your cake and eat it too, is what they're saying. So how do you make this election, and what does it apply to? Well, you make the election on Form 4952. The other rule on investment interest is that the deduction for investment interest cannot exceed your investment income. So 4952 serves a function. The first one is that it allows you to make an election to have your capital gain income treated as investment income. The other reason that you would fill out Form 4952 is when your investment income is less than your investment interest. You use the form to claim the allowable portion of interest that you paid and then to carry forward any disallowed amount. So here we have an illustration of how the form and the rule works. Austin Powers has made the following investment in capital gain income for 2011. He's received a 1099 INT with Box 1 ordinary interest showing in the amount of $100. He also has a 1099 DIV with Box 1 ordinary dividend income of $300. So you can say that he has investment income here of $400. But his 1099 DIV also has Box 1B completed showing qualified dividends of $200. And remember that when you're looking at a 1099 DIV, the amount in 1B is included in 1A. So Austin Powers has $400 of income that is interest and dividend income, but of the dividend income, $200 is actually capital gain qualified dividend income. And then in addition to the dividend and interest income, he also has on the same 1099 DIV capital gain distributions in the amount of $300. So he has $200 plus $300 equaling $500 of capital gain income. And up here he has $100 of interest plus $300 of dividends, of which $200 is qualified dividends, leaving only $100 of dividend income being actual investment income. So in the end, we have $200 of investment income and $500 of capital gain income. You all with me on that? Let's take a look at the finished form. And the starting point on the 4952 is to enter the investment interest expense paid in 2011, and that's $800. And then in the wording of the problem, I told you had a $100 carryover from the year before, and that goes on line 2. So his total investment interest expense that he's going to try and deduct for 2011 is going to be the total of those two amounts, $900. Then we look at line 4A. And line 4A is where we enter the gross income from property held for investment. And if we go back up and look at the wording of the problem, we see that we had $100 of interest and we had $300 of dividend income. That's the amount that we're working on. So we enter that on line 4. But the next line, 4B, says what portion of line 4A is for qualified dividends. We're going to have to subtract that amount out. And that leaves us with only $200 of investment income. But up here we have $900 of investment expense. So if we don't do anything special, our deduction is going to be limited to $200. So this would make sense for Austin Powers to be able to make an election to have his dividend and capital gain income treated as investment income. And he does that on lines 4D and 4E. So on line 4D, he enters the amount of capital gain income that he had. And to that, he adds the qualified dividend income that he had. And he gets a total of $500. He's going to add those numbers together, the 500 and the 200 of actual investment income, and then he gets $700. So he could take only $200 as an investment interest expense deduction, or he can elect to treat capital gain income as investment income. And if he does that, he can add $500 of investment income to the investment income total, and then his deduction could be a full $700. But no matter what, he's still going to have $200 that he can't claim, and he carries that forward. So in summary, where do you get to deduct all of the interest expenses that you might have had during the year? Well, you can deduct them on Schedule A if they're qualifying, but there are other places and other types of interest that you might have paid for the year. If you paid student loan interest, that is deducted on Form 1040, line 33, or 1040A, line 18. Deductible home mortgage interest that is reported on a 1098 is reported on 1040, Schedule A, line 10. Deductible interest not reported on a 1098 goes on line 11. Points not reported on a 1098 go on line 12. Mortgage insurance premiums, if they are deductible, go on line 13. Investment expense that is not incurred to produce rents or royalties that would be reported on Schedule E go on Schedule A, line 14. If you paid business interest operating a business that is reported on Schedule C, then you would claim that business interest on the Schedule C. If you paid farm business interest, that would be reported on Schedule F. If you paid interest incurred to produce rent or royalty income, that goes on Schedule E, and any other form of personal interest is not deductible at all.
Session 9 password number 2 is josey, J-O-S-E-Y.
Charitable contributions and how to deduct those on our tax return. You can deduct your contributions to charity only if you make them to a qualified organization. So this is the first test. Did I make a donation to a qualified organization? If I did, I can claim a deduction on my Schedule A. And I claim that deduction on lines 16 through 19. You cannot deduct a cash contribution regardless of the amount unless you have a record such as a canceled check or bank statement showing the name of the charity, the amount, the date, or written communication from the charity. So this is a rule that's been around for a few years now. It used to be that if you made cash donations to charity, you didn't have to have a receipt if it was a small amount, and the IRS didn't really care about that, or they let you get away with a small amount of charity that you didn't have to keep a receipt on because it might be impractical to get one. And a place that it's kind of impractical to get a receipt is from, the Salvation Army Santas at Christmas time. Obviously, Salvation Army is a qualified nonprofit organization, and as we're walking in the door of the Safeway and we drop $2 or $5 in Santa's little can there, is that a deductible expense to us? And the answer is not if we didn't get a receipt. Yes, if we did get a receipt, or maybe if we wrote a check and we have the canceled check, that would qualify as well. But we have to have some form of payment, a canceled check or bank statement showing the name of the charity, amount, date, or written communication from the charity. So if we wrote a check to Salvation Army for $5 and dropped it in Santa's bin there, that would work. Otherwise, we have to get a receipt. So maybe Santa has a receipt that he can give us at the time. All in all, it does take away from the spirit a little. I do not stop and ask for a receipt. I just put my change in there and move. Also, in order to be deductible, you cannot benefit from the charitable contribution that you make. You cannot claim a deduction for a contribution you make to an organization to the extent that you benefit from the contribution. For example, the most common one is you purchase an item from a charitable organization. If you do, you must subtract the value of the item you purchase from the purchase price. And you can claim a deduction to the extent that you paid extra for that item. Here in Portland, school auctions are real popular, and I'm sure they're popular in other parts of the country as well. Schools are screaming for money, they're short for cash, and so the PTAs put together these school auctions to raise money to pay for extra teachers, extra school supplies, music programs, things of that sort. And the parents go and they get worked into a fervor and they start bidding. Now, to the extent that they bought items and came home with them, the parent may think, quite logically, that they have made a charitable contribution. After all, the money did go to the PTA. They sat in a room with a bunch of other parents bidding in a frenzy on all of these items. Do they get a deduction? And the answer is, if they donated more than the item was worth, or if they paid more for the item than it was worth. But if they didn't pay more than it was worth, then the answer is no. Let me think of a good example. The year before last at my children's charity auction, there was this 4th grade art project. It was an outline of the city of Portland, and it was all done in metal work. Quite nice. It sold for some ridiculous sum of money like $3,000. Presumably the 4th graders made it. Was it worth $3,000? Only to that mother. No other parent in the audience was willing to pay $3,000 for it, and I'm sure when she goes to her grave, she'll never be able to sell it for $3,000 to anyone. So that's going to be a hard one to quantify. What is it really worth? But someone's going to have to come up with a number, and the deduction allowed to that parent is going to be the difference between what that item is worth and what she paid for it. And what it's going to be worth is the price that it would sell for between a willing buyer and a willing seller, with neither one being forced to buy or sell. My bet is it's maybe worth $200-300. So I'd claim a deduction for the difference. Now other things are a little bit easier to pick out. For example, you could purchase 2 tickets at a charity auction and the tickets are valued at $100, but you pay $150 for them. Your deduction is going to be $50. So you purchase 2 tickets at the charity auction, and you cannot claim more than, you cannot claim the value of those tickets. You can only claim the excess. $50 more than you paid is the deduction. Or you paid $50 more than they're worth, and that's the deduction. All right. Nextly, we have membership fees or dues paid to qualified organizations. You can deduct the cost of membership fees that are $75 or less. You can deduct a larger amount only to the extent that you do not receive additional benefits solely because of the higher dues. If you pay extra to receive extra benefits, you must subtract the value of those benefits from your charitable deduction. You can pay more than $75 and still receive a deduction for the extra amount so long as you do not receive additional benefits of value that are not available at the lower membership rate. So this is one that gets my clients. They don't really think that the membership to the zoo is charity. Wouldn't cross their mind that the fact that they purchased a membership that gets them to the zoo as many times as they want for free for a year could possibly be a charitable deduction. But it is. And at least here in Portland, I have observed that virtually every membership I might ever purchase to any organization is $74. Portland Art Museum, Oregon Zoo. $74 seems to be that magic number. And you can go higher than that with, patronage memberships. But they seem to have this magic entry point, probably for a very specific reason. Now, if you happen to have taken out one of those patronage memberships, can you deduct more? And that's a good question. I've taken out a higher level of membership at our zoo for years because it allows my children to bring their friends. Is that a benefit of extra value that means that I can't claim the higher cost of that membership? Well, the Oregon Zoo on its letterhead has told me I still get the full deduction. So it's basically saying that the fact you can bring your friend in under the same membership is of nominal value, and you're getting it. So we have example number 1. You obtain a family member at the zoo for $74, even though you are entitled to a free admission to the zoo with your membership. Because the cost of membership is $75 or less, you claim a deduction for the membership fee. Example number 2. You obtain a $500 zoo membership as a special sponsor. You gain additional privileges of nominal value, such as you don't have to pay the $1 parking fee, and you can claim a $500 deduction for your zoo membership. Written statement required if payments for benefits is greater than $75. So if you did pay this higher amount up here, you do want to see a written statement coming from the charitable organization that confirms how much you really do get to deduct. And I have seen that coming from our local zoo. So I would be looking for it and asking your clients for it. If you want more information about what that written statement should contain, refer to Publication 17, pages 162 through 163. And there I see a question from Kate. How does the membership to the zoo be deductible? Because the zoo is a qualifying nonprofit organization, and money you pay to have a membership in a qualifying nonprofit organization is deductible if it is $75 or less. And you can still claim a deduction even if it's more, to the extent you don't receive benefits of value for that higher membership amount. Another way to look at it, see, the zoo is somewhat a little bit tricky because you really do get a clearly defined benefit when you become a member of the zoo. You get free admission for a year, and that has a value. You take your kids to the zoo, and it might cost the family $30 to get in the door. So, a value is there. However, it doesn't matter. Let's look at another one. I take out membership in PBS. The public broadcasting channels that are public broadcasting channels. They're free. You can listen to them. You can watch them, right? And every once in a while they have their pledge drives and they ask for money. And they might ask you if you want to take out a public broadcasting membership for the year for $35. What are you getting for the $35? I'm a member, and maybe they'll send you a newsletter 4 times a year, right? It's the same idea. It's just a way for that organization to raise money by calling you a member. And they are allowed to give you a few things of nominal value, and you're still allowed the full deduction for that membership. If you do not believe me, if you have a hard time understanding what I'm saying here, it's right in IRS Publication 17. Go read it for yourself. Volunteer expenses. You can deduct expenses you pay to provide volunteer services to a qualified organization, but the expenses must be unreimbursed, directly connected with the services, expenses you had only because of the services, and not of a personal or family nature. Conventions. You drive to a convention, and can you deduct the cost of attending the convention? The answer is generally no. But if you are a chosen representative of a qualified organization, you can deduct the travel and meal expenses directly relating to your official duties for the organization. You may not deduct the cost of personal activities or the cost of bringing family with you. Uniforms. You can deduct the cost of uniforms you must wear while performing donated services which are unsuitable for personal use. Examples would be deducting choir robes for your church choir or volunteer firefighting gear. Foster parents. If you care for a child placed with you by a qualified organization, you may be able to deduct expenses that are unreimbursed and out-of-pocket costs to feed, clothe, and care for the foster child, and mainly to benefit the qualified organization. Expenses you incur caring for a foster child you intend to adopt are not deductible. One of the things I should point out on foster children is that typically if you are a foster parent, the state is actually giving you money for the care of that child. So when we're talking about unreimbursed here, you're going to have to spend a lot of money on that kid. Because what I'm seeing is when foster children are placed with families, at least here in Oregon, they get big checks, like $1,400 a month for that kid. And it is possible to spend more than $1,400 a month. Trust me, I got 2 kids of my own, and they are expensive. But if you've got foster kids and you're receiving money from the state for the care of those children, your charitable deduction is going to be limited to the amount that is above and beyond what the state is giving you for the care of that child. Transportation. You can deduct car expenses you incur while providing volunteer services to a qualified organization. You can claim the actual cost of gas and oil, but not the cost of repairs, maintenance, or depreciation. Or you can claim 14 cents per mile. You can deduct the cost of parking and tolls, and you must keep records to prove those expenses. You may not deduct the cost of driving to church unless you go to church on official business as a volunteer. Travel. Travel expenses you incur while providing volunteer services to a qualified organization can be deductible. You must be performing services for the organization, and it must be a qualified organization. There can be no significant element of personal pleasure, and the trip must be substantially for duties you are performing for the organization. If you have only nominal duties, or if specific portions of your time are not spent performing your duties, you can't claim the cost. Exchange students, this one gets me. You are allowed to deduct expenses you paid for students living with you under a written agreement with a qualified organization. You can claim a deduction of up to $50 per month per student enrolled in the 12th or lower grade, but the student cannot be related to you, the student cannot be your dependent, the student must be attending school full-time for 15 days or more in the months claimed, and you cannot deduct the cost of a foreign student living with you in your home under an exchange agreement in which your child goes to live with a foreign family. But this $50 a month, it's obviously not been indexed for inflation. 14 is not indexed for inflation either. One of my students is complaining. Non-deductible contributions. I've got a picture of a panhandler here, a beggar. Lots of my clients say when I ask them, when did you give money to charity, they say, yeah, I gave away a bunch of furniture to my neighbor, and I gave this every week when I pass this peddler on the street, you know, this handout, I give him 10 bucks. Not allowed. Next. Contributions to non-qualified organizations. You have to be giving to a nonprofit that is registered with the IRS. And if you're ever in question, you can actually go to IRS's website and look these charities up. But examples of non-qualified organizations include homeowners associations, labor unions, civic leagues, chambers of commerce, and politicians. No. Okay, contributions from which you benefit. You cannot claim a deduction for contributions you made to a qualified organization to the extent you receive benefits, and we already talked about that. Value of your time or services. This is a favorite. I donated my time to the organization. My time on the job, I get paid $20 an hour. Can I deduct $20 an hour for the time I put into the charity? The answer is no, no, no. And quite logically, the reason for that is you haven't reported any income from it. You don't get a deduction for something you never had a cost in. Cost of meals. Unless your volunteer duties require you to be away from home overnight, you may not claim a deduction for the cost of meals. Adoption expenses. Costs associated with adopting a child are not deductible, but you might be able to claim an adoption credit. Next, we're going to look at some of the rules that apply to non-cash contributions. This is the most common kind of contribution I really get, or at least the largest denomination or value of contribution. Now, many of us have clients that do give a lot to their church. That's a real common one. But aside from church, non-cash contributions are really the largest category. And usually they beat church anyway, at least with my clients. So non-cash is something that is underused and over-abused at the same time. It really depends on the client you're working with. Some clients come in and give these grossly inflated valuations on their property, saying they gave away $10,000 worth of stuff and they want a $10,000 deduction for it. And other people give away $5,000 worth of stuff and want to claim $200 for it. So somewhere in there, we as taxpayers have to help them arrive at a real good number, something that's realistic that could be supportable in an audit. And the first step is to determine the fair market value of the item. If in doubt, you can always refer to IRS publication 561. You can also go to the websites of Goodwill and of Salvation Army. They have valuation guides in there. But that's not the final say. You could claim a value that is higher than what is in publication 561 or on the Goodwill site. But you need to be able to support the value that you're claiming as being a realistic fair market value for that item. And I guess the best description I can give you is for a client that I worked with who actually got audited. She claimed a big charitable deduction, and she got audited on it. But I was very thorough as her preparer. And what happened was she got married, and she had a lot of nice, expensive stuff, and she was moving into her husband's home and gave away a ton of it. She gave away Persian rugs. She gave away exercise equipment. She gave away furniture, all of which was expensive stuff, not stuff she bought at JCPenney, but stuff she bought at designer furniture stores and expensive stuff. Did she get an appraisal on any of it? No. Well, that's not true. She did go into a couple of Persian carpet type stores to ask the salesman what they thought it was worth. And she kept a record of what they'd said. So she had some items where she'd put some effort into herself to figure out what it was worth, but she had many more items where she had no clue. And so I said, well, we need to do some work. And I said, you can do it yourself or you can pay me for my time to do it. And in the end, she paid me. I did not charge her enough, but I did put some time into getting some valuations. And the place that I went was eBay. Lots of stuff gets sold on eBay. And so I went to eBay and I just started doing searches for the types of things she was giving away. And I described the piece of exercise equipment that she donated. I described the clothing that she donated piece by piece. And when eBay popped up pricing, I would look kind of for the average and I'd print it out and we saved it all. She got audited. And the donation we claimed was in the many thousands of dollars, many thousands of dollars, and the auditor allowed all of it because we'd done our legwork. So, no, we didn't go with what Goodwill sells it for because that wasn't realistic for her stuff. Her stuff was nice stuff, not JCPenney or Kmart stuff, but Nordstrom stuff, Saks Fifth Avenue stuff. So those are the questions I asked my client. Where do you shop? Not that I'm snoopy. I'm just trying to get a gauge of where the garment that they donated came from. And if it came from JCPenney or if it came from Kmart, clearly it's going to have a value where Goodwill is going to be a good gauge or the IRS publication is going to be a good gauge. But if they just shop at designer stores and pay $500 for a suit jacket, that's going to be selling for a much different price. So where do I go? eBay is a good point, but also just into some of the higher end resale stores that like to sell used designer clothes. That would be a good place to go to get your valuations, and that's what I did. Now, what happens if you donate cars, boats, or aircraft? If you donate a vehicle, including a boat or aircraft, to a qualified organization after December 31, 2005, your deduction is limited to the gross proceeds from the sale by the organization. Now, most of these organizations auction those vehicles off. The most you're allowed to claim is $500. Unless it sells for more at auction. If it sells for more at auction, they're supposed to send you a 1098-C, and I actually have a 1098-C in the course manual. It's a part of Classwork Assignment 3 on page 57. This 1098-C is a required attachment to the tax return. So if your client says they donated a vehicle and they want to claim more than $500 because it's sold at auction for more than $500, the 1098-C document has to be attached to the tax return like a W-2 is attached on a paper return. But even more so, IRS is requiring, even if you electronically file, that this particular document be attached to the electronic return. Well, how do you attach it to an electronic return? You have to attach Form 8453 to the 1098-C and mail the 8453 in with the 1098-C attached. This is something that has to get mailed into the IRS, whether you're the preparer or the taxpayer. So if the taxpayer is self-preparing their own return and they prepare a paper return, they should attach this document. We as tax professionals, we're not allowed to file paper returns for our clients. We are required to electronically file the returns. So when we electronically file a tax return where a client is claiming the donation of a car, boat, or aircraft that was sold at auction and a 1098-C was issued, that 1098-C needs to be attached to Form 8453 and mailed to the IRS. It's the responsibility of the electronic return originator to do that. So this particular 1098-C was issued to Angela Biggins by the March of Dimes, and it's showing the gross proceeds from the sale of that vehicle were $1,000. That's going to be the amount she is allowed to deduct. Now, one of the things we get at in the world of itemized deductions when we're claiming deductions for contributions of non-cash items to charity is how much do I get to deduct? And the amount you're allowed to deduct on a non-cash donation to charity is the lesser of your cost or your fair market value in the property on the date of the donation in most cases. So if I donate a car that I held for less than a year, the most I could claim is the cost, and the cost will probably be more than the fair market value. So I would go with the fair market value, and it would have to sell at auction for that. The only exception to that on the donation of vehicles is if you donate it to a charitable organization that does not auction it off. It uses the vehicle in furtherance of its charitable purpose. So maybe Meals on Wheels is asking for donations of cars so the volunteer drivers can deliver free meals to needy people. That would be an example of a car being donated to a charity and the charity is using it in furtherance of their purpose. But if you donate it to Meals on Wheels and Meals on Wheels auctions it off, then you can only claim what it sells for at auction.
Session 9 password number 3 is Wales, W-A-L-E-S.
So we're going to talk about some of those rules here. The limits on deductions. There's generally no limit on the amount of deduction you can claim if the total cash or non-cash contributions you make to charity are 20% or less of your adjusted gross income. I often get this question from people, is there a limit on how much I can donate to charity? No. You can donate everything you own to charity if you want. Is there a limit on how much you're allowed to deduct? Well, the limit is your income. It's based on your income. If your income's $100,000, in most cases you're going to be limited to a deduction of half that, $50,000. Well, there's few people out there that give away more than half their income. I've seen it done once in 20 years. It is possible, but it is rare. Most people make contributions to charities that are 50% organizations, but some people make contributions to charities which are referred to as 30% organizations. So what is the difference between a 30% organization and a 50% organization, and where the heck did 20% come from in that equation? So we're going to learn a little bit about that. I find tax preparers are confused by this 50% organization title all the time. They equate that to mean something like I'm allowed to deduct 50% of my meals, so I'm allowed to deduct 50% of my charity. That's not what it means at all. It means that your deduction is limited to a percentage of your income, not that the deduction itself is limited to half what you donated. That's not at all what it's saying. So what is a 50% organization? Well, virtually all charities are 50% organizations. There's only a few that are not. Examples of the few that are not 50% organizations are veterans organizations, fraternal societies, nonprofit cemeteries. Those are examples of 30% organizations. Churches and 501c3s are 50% organizations. And if you donate cash to a 50% organization, your deduction for a cash donation is limited to 50% of your income. So if I earn $100,000 in the year and I get really, really excited because the zoo is building a new exhibit and I want to be one of the founding patron sponsors, so I donate $60,000 to the zoo in cash, now I would be limited. My deduction would be limited to half my income. If my income is $100,000, my deduction would be limited to $50,000. And what would happen to the extra $10,000? Carries forward to the next year. I can use it then. That's a pretty rare thing for someone to donate that big a percentage of their income. But if I donate a non-cash piece of property to a charitable organization, that is appreciated in value, then my deduction is going to be limited to 30% of my adjusted gross income. So even if you contribute to a 50% limit organization, your deduction will be limited to 30% of your AGI if you contributed capital gain property. What is capital gain property? Capital gain property is capital asset held for more than 1 year. It includes things like stock bonds and, well, that painting bought at Christie's auction. That would be an example of capital gain property. So if I'm that millionaire investor who happens to have that fancy painting from the Christie's auction that's now worth $1 million and I paid $300,000 for it, I have unrealized gain in that painting of $700,000, don't I? I paid $300,000, it's worth $1 million. The unrealized profit, I've never sold it, so I've never made the money, but the unrealized profit in there is $700,000. And the law does say I can donate that whole painting and claim a $1 million deduction, even though I only paid $300,000. But if I do that, my deduction is going to be limited to 30% of my income rather than 50% of my income. So I could be carrying forward that deduction for a long time. So there's also these 30% limit organizations, and I already explained who they typically include. Veterans Association, fraternal societies, and nonprofit cemeteries are the ones that typically get listed. They are referred to as 30% limit organizations. You're allowed to donate cash or property to them, and you are allowed to claim a donation for what you donate to them. But your donation is going to be limited to 30% of your income if you donate cash, and it will be limited to 20% of your income if you donate capital gain property. So if you donate capital gain property to a 50% limit to organization, your deduction is limited to 30% of your income. And if you donate capital gain property to a 30% organization, your deduction will be limited to 20% of your income. Any other amount carries forward. Records to keep. To deduct any charitable donation of money, even $1, you have to keep a record, including a canceled check, a bank or credit union statement, or a credit card statement to prove that you made that donation. For cash contributions of $250 more, you must have a written confirmation from the qualified organization. You must obtain written confirmation by the time you file your timely filed return or by the due date, including extensions for that return. Okay, out-of-pocket expenses. If you have deductible volunteer expenses, you must maintain adequate records to prove your expenses and, by the required date, obtain written acknowledgement from the organization that confirms you provided the services and what portion of your expenses were not reimbursed by the organization. And you must keep a written record of each item you donate. The written record should show a description of the property given, the date of the contribution, the fair market value of the property you donated, the cost basis of the property given, the amount of the deduction you are claiming on your return, and you must get and keep a receipt from the organization that shows the name of the organization, the date of the contribution, and a description of the property given. Non-cash contributions of $250 or more, you have to maintain all of the records mentioned for non-cash contributions, plus you have to have the written acknowledgement. So IRS is saying in most cases when you make a contribution of non-cash items to a charity, you have to have a receipt. But if you made a small drop or a series of small drops during the year at an unattended Goodwill drop site, it's possible to just keep a written record of the date and value of the contribution, a description of the contribution, and you can claim a deduction of up to $250 on your return without having a receipt. But anything over $250, you have to have a written acknowledgement.
And it is now time to complete the Session 9 classwork assignment. I have up on the screen in front of you the classwork assignment for Session 9. It is on page 24 of your manual. We're going to now take a look at the wording of the problem, and it simply says you're going to need to complete a Schedule A and a Form 8283 for our character named Angela Biggins. Her AGI is $30,000 for 2011, and her 1098 mortgage interest paid for the year is $5,000. Her property taxes were $1,000. Angela had $3,000 of state withholding on her W-2, and during the year she gave the following items to charity. A 1990 Civic with 209,000 miles that she purchased in 1997. It sold for $1,000 at auction. The basis in the car was $2,000, and she also donated $500 of cash to her church during the year. She had some volunteer search and rescue costs. She drove 1,000 miles, plus she paid $1,000 for the cost of caring for search and rescue dogs. Prepare her Schedule A. Just as a reference, I wanted you to know that this is an actual form that must be sent to the IRS. So if you are preparing a tax return and your client has a 1098-C, this is a form that actually has to be sent to the IRS. And if you're electronically filing, this would be one of the reasons that you would need to file Form 8453, and you would attach this document to the 8453, and then if the tax return is a paper tax return, then it would be attached as a document to the paper tax return in much the same way that a W-2 is. So you can see that the car was donated to the March of Dimes, that the date of sale was 8/12 of 2011, and that the gross proceeds from the sale were $1,000. So at this point, please push pause on video playback, complete the Session 9 classwork assignment for Angela Biggins, and when you are ready, resume playback for a review of the classwork answer key. And I have on the screen in front of you the classwork assignment answer key for Session 9. And we're going to begin with a discussion of Form 8283. This is the first time we've asked you to complete it. The fair market value of the total non-cash items that Angela contributed to charity during the year is greater than $500, and therefore this form is required. And for each contribution that Angela made during the year, she must enter the following information on the form: a description of the item or items that she donated, the dates that she donated them, the date and how she acquired them, the cost that she has in them, and the fair market value and method that was used to determine the fair market value. Now, in the real world, when you have a client, you would simply interview them, ask them these questions, and then enter the information on the return. But we didn't really provide you this information for Angela, so whatever you decided to enter there is fine. You can just make it up and enter it, and ultimately, that's what we did. I'm going to move down to the 8283 first, and you can see what we did. We've entered March of Dimes, got the description that is a Honda Civic. The mileage is 209, and the condition was good, used. Then, in the date of the contribution, we enter 7/1/2011, and we've got an acquisition date of 1997. How was the vehicle acquired? It was acquired by purchase. How much did Angela pay for the car? She paid $2,000. How much was it worth? Well, it's worth what it sold for at auction, and that was $1,000. After completing the 8283, we move back to the Schedule A. And on the Schedule A, let's take a look at it and also reference the problem itself in the course manual as we go. Inside the course manual, one of the items that we tell you is that she had withholding of $3,000 on her W-2. We're going to enter that as state income taxes paid. The next item in line is $1,000 for real estate taxes, and we're telling you here that she paid $1,000 for real estate taxes. So her total taxes that she can deduct for the year are $4,000 on line 9. Then on line 10, her mortgage interest is $5,000, and again, we gave you that amount in the wording of the problem. Right here, it says $5,000. Then we move on to line 16, gifts by check or cash. Well, how much did she give by check or cash? Well, interestingly, her volunteer expenses, the cash she paid for volunteer expenses is considered to be a cash contribution to charity. It often stumps people. Is my volunteer expense a cash or a non-cash donation? Well, a non-cash donation is an in-kind donation where you contributed your property. But when you contribute your time, you don't get a deduction for your time, but you do get a deduction for any of the costs you incurred in donating your time. And the volunteer costs associated with search and rescue were 1,000 miles driven, plus 1,000 for the cost of caring for those search and rescue dogs. How do we figure that deduction? Well, we're going to take a standard mileage rate for charitable miles driven. So the allowed deduction that you can claim for volunteer expenses for use of your car is 14 cents a mile. It's a pretty small number compared to what you get for medical, moving, and you will see later for business mileage. For charity, you are allowed 14 cents a mile, so we're going to take 14 cents times $1,000. That's $140. We add to that the cash that was donated to the church in the amount of $500, and the $1,000 cost of caring for the search and rescue dogs. So you take $1,000 plus $500 plus $140, and you get $1,640. Next in line is the amount shown on Form 8283. We calculated $1,000, and that leaves us with deductible charitable amount of $2,640. We add up our taxes, our interest, and our charity, and we get total itemized deductions on line 29 of $11,640. So that concludes the review of the classwork answer key. Let's return to the manual and take a look at the homework assignment for session 9. And this time we have an assignment involving preparation of Form 1040, Schedule A, and the state and local sales tax deduction worksheet. Our character is Dr. Hewer. He is single, and he lives in Auburn, Washington. Washington stands out because it's a state that does not have an income tax, but it does have a pretty steep sales tax. Dr. Hewer works as a doctor and wants to contribute $3 to the Presidential Election Campaign Fund. He bought his first home as a contract sale from Wilma Deering, and during the year he took out a home equity loan to buy a new boat. He also took out a home improvement loan secured by his home during the year. Dr. Hewer has no idea what he can deduct and is hoping that you can help him. He has the following income and expenses. You can see we have interest, we have dividends, and we have a whole list of expenses. Your job is to sort through those, determine what he can claim, what he can't claim, and prepare his tax return. Have fun with that, and I'll see you next time at the beginning of Session 10. Bye-bye.